Great. Thank you very much, Ian. So we're going to try and make this as interactive a session as we possibly can. During the session, I'm going to ask you, the audience, some questions with the traditional raising of hands as to your appropriate answers. So if you've had a cup of coffee and you're fired up for this particular session, we're going to have a lot of fun. We're going to start off, however, with a few questions for the panel. And I think it comes at a really interesting time in the UK housing market. Clearly, we've seen very strong levels of house price growth. So in the period since the pandemic, prices have gone up by something like 18% according to the Nationwide, something that was pretty much completely unexpected for most housing market commentators at the inception of the pandemic. Transaction levels have soared to 1.5 million over the course of a year. That's well above the normal post-credit crunch number of 1.2. Yet we find ourselves in a position when a lot of that growth was facilitated by this very low interest rate environment and the ability to lock into low interest rates. And we face the prospect now of rates rising and questions about whether mortgage regulation will change and what that might mean. So I'm going to start off with my first question. I'm going to start with you, Steph. Clearly, we've seen a strong boom, mini boom in the housing market. How has that, from your perspective, specifically played out in the specialist lending sector?
Well, I think actually probably the specialist lending sector is coming to its own throughout the pandemic. So I know we saw at the beginning the specialist lenders having to step back slightly. We didn't know what the future held, and as you said, we never would have predicted at the beginning of this that we'd be where we are today. But actually, as the criteria came back, and Adrian will correct me on this if I'm wrong, as that criteria came back, the solutions that the specialist lending market offered for customers who've been impacted by self-employed, dip in 1 year's accounts, adverse credit, contractors. I think the specialist lenders come into it and will continue to grow. I think there will be growth.
Because I guess one of the things that we saw is that the demands on the mainstream lenders became intense.
Yes.
Just that volume of business they had to deal with from upsizers who probably had a good credit history, could operate in normal loan-to-income ratios, relatively low LTVs, I guess created more space, perhaps, for the specialists?
Yeah, I think we all faced our challenges, Lucian. I think some of that was around capacity and processing because, you had a twofold thing. None of us expected the payment deferrals. That was put on us overnight, literally. I know they said payment holidays. I think deferrals is a better way of dealing with that. So every lender in that space had to cope with processing those. No one had built in almost a disaster recovery plan in how to process those stuff. Coupled with, you want to continue lending. We had the challenges in phase one of surveyors not being able to go out, visit houses, survey properties physically. So at the lower LTV point of the market, you saw the high street players being, really fighting for business there, using automated valuations, etc. But the market got back on its toes pretty quickly.
It was remarkable, wasn't it?
Oh,
I think the stamp duty clearly distorted it. One of the things that I find amazing is that you can offer a £15,000 stamp duty holiday, and the bulk of people faced with that will leave any financial acumen they've ever accumulated over their lifetime at the front door and pay £30,000 more for a house. What did that stamp duty distortion do in terms of processing capacity in your sector? Did it completely bunch things up? Did you learn much from it?
Look, I think actually the lending part of the process, if you like, and the broking part fared really, really well. We worked together in tandem. There was an acknowledgement of working together, communication. Nobody's perfect, right? Let's get that bit there. But I think what you saw was the vast majority of people that wanted to purchase a property and take advantage of the stamp duty holiday, if you like, got their purchases over the line. And I'm sure we'll come on to it perhaps as part of the debate. Probably the biggest challenge in that part of the process was the legal process. Because, I've been in this industry 25 years. I know I don't look old enough, obviously. I did have a head of black hair at one stage. But our market has evolved somewhat. We work closely in my business. We only work with intermediaries. The advice is really good. They engage with us in the process. They understood the challenges we face. The whole conveyancing process hasn't changed since I took out my first mortgage.
Yeah.
It's still quite laborious. It still takes time. And you couple that with conveyancers. And I think they did a reasonably good job given the parameters they've got working from home. They got a lot of them over the line. But that, I think, as we look at the mortgage market, is a key bit that we have to look at going forward and seeing how can we speed up that end of the process?
Yeah. So what's interesting is there's some lessons learned from the pandemic, isn't it? Just in the way that we operate, yeah. we've all come up with some new challenges. I wanted to move on because we're going to be quite short on time and just talk a little bit about the economy and what's going on in the economy. Steph and I were talking beforehand. I think you said you had to turn off your television this morning or change channels to Homes Under the Hammer repeat because the news agenda was so relentlessly negative with a cost of living crisis, prospect of energy costs going up even further, and a Bank of England decision later today on interest rates. Before I ask you the question, I can see from the excitement in the audience that we've got with us that you're dying to answer a question. So let's start off with, we're going to do two. The first one we're going to do is hands up if you believe that in bank base rates going to go up today. So that is the vast majority of people. We'll have the don't knows just so that they feel included. And then they don't think it's going to go up. Okay, who think it's going to go up by more than 25 basis points? Is there anyone in the room who thinks that it's going to go up a bit quicker than the market's expecting? Okay, so look, it looks pretty much nailed on from this room, who are probably as intelligent and good at forecasting as the MPC, it's got to be said. I know it's a very intelligent bunch. So rates are going to go up, cost of living squeeze. At the same time, in the mainstream market, we've seen mortgage approvals progressively fall over the course of the year. They bounced a bit in December. They were up by 5%. What do you think that does to, firstly, demand in specialist lending sector? Do you think it pushes it up? Do you think it pushes it up dramatically?
I think yes, it will, and it's unfortunate that it will to a certain extent. So I think one of the stats I heard today, which was when I turned the TV off, was actually an increase of £30 a month on the average person's utility bill will be enough to push them over, the edge sort of slightly up. So, will they choose between, we were talking earlier, between heating and eating. But actually, maybe people will choose heating and eating, but not paying their credit card bills, not paying their mortgage. So will we come to that? And actually, will that take a little bit of time to come through? I don't mean to be negative, but I think that's where we'll perhaps need to have those conversations with customers to make sure that they're aware of the impact of that. So I think there will be a demand for specialist lending moving forward. An unfortunate consequence, I think, if I'm honest. But buyer demand is up. Zoopla recorded that actually in January it was up 49%. So I think pent-up demand's become continuing demand. So I think it's all very, very positive, but I think we have got this sort of backdrop of uncertainty.
Yeah, I think that experience of living, working, I don't know how many of you had to school at home, but it really was a living nightmare, I would say, throughout that period. And I think for all of us, that made us sort of question whether or not our home was adequate for our needs. And I suspect that that's going to run on for a little bit, but against the context of this slightly tightening economy, we're forecasting, just as a matter of interest, that transaction levels will come back closer to that normal post-credit crunch norm of 1.2 million. We think house price growth might be in the order of 3.5% this year, but we pride ourselves on being the least inaccurate housing market forecaster. So make of that what you will. Interest rates going up. Specifically, buy-to-let.
Yeah, okay.
So you've got a bit of a double whammy here, haven't you?
Thank you.
Interest rates going up and tax relief constrained.
Yeah.
What does that do?
Well, I think most people have dealt with the tax relief. The vast you've got two types of landlord. You have got the landlord that runs their portfolio as a business. You've probably got the, amateur landlord. People used to refer to them as a dinner party landlord, but I think that terminology has kind of moved on. Actually, interesting, last year, Lucian, you still saw people look to retain assets, even if they were moving house and let them out. That was a fact of a transaction. Landlords benefited, actually, from the stamp duty incentive, 3%. I was surprised by that because historically, the Conservative government, particularly under Cameron, had focused on first-time buyers, residential homeowners. So that caused a boost in buy-to-let lending last year, up to 45 billion. That will probably settle still slightly back this year at 40 billion. Still a good market. The beauty for landlords is actually the availability of funding, the availability of cheap funding. So, it's ultra competitive out there at the moment. We talk about base rate moving up. Swaps have gone up, which is where the 5-year market is aimed at. I think 20 basis points or so since before Christmas. Yet you haven't seen 5-year rates move up. Actually, what you've seen is lenders reducing their 5-year rates.
So that competition on lenders' margin remains intense.
Yeah.
And that might just offset a little bit of this upward base rate.
Yeah, and
pressure.
I think, and it isn't just in buy-to-let. If you actually look at rates across the market, you are not seeing a massive drive of rates going up because liquidity within the sector. This isn't a financial crisis by any matter of the means we're dealing with here. We are dealing with a very buoyant market where lenders have funds to lend. Actually, if you look at the pandemic, 71% of people save money. Whether that's the case now, if you look at what my wife spends at Amazon on credit cards, it's probably eradicated that. But actually, people had managed to pay down unsecured debt, save money. From a buy-to-let perspective, I don't think it's a massive impact of variable rates going up because the vast majority of landlords fix for 5 years. They benefit from the ability to stress against a pay rate as opposed to 5.5 under the PRA rules.
So buy-to-let landlords have had a pretty good time.
Yeah.
Lending market's been very competitive, but there's change coming. We know there's change coming for buy-to-let landlords, and a lot of that's going to come through regulation, particularly with this sort of rising ESG agenda, the prospect that you're going to have to get to a minimum rating of EPCC. You might get an exemption if you have to spend more than 10 grand getting there, but it's not going to last long. Firstly, what do you think that does to the demand for buy-to-let product, and where do you think the specialist lending sector goes in, partly in funding the improvements that they're going to have to make? Because that seems to me, because you could be quite negative. You could say, actually, it's going to suppress buy-to-let landlord demand, they're going to get scared. But there's an opportunity in there, isn't there, to fund some of those improvements? So, Steph, do you want to pick that up first?
Yeah, I think to start with some context, I think it's around 60% of buy-to-let property stock is EPCD or under at the moment. So there's a massive step to move forward. The consultation paper, the improving the property rental sector, hasn't actually been, it's concluded in the 8th of January, I believe. So actually it's going to be the summer before we actually see that legislation come into force. But we are expecting that actually what we've seen in that consultation will actually come into effect. But we expect the deadlines to probably move out slightly, so that sort of 2025, 2028 will probably push for sort of existing and new tenants. There is opportunity there. I think for me it's around talking to landlords now and making them aware. Change is coming, you're quite right. We've seen ESG.
So you make a really interesting point there, making them aware.
Yes.
Yeah. Do you think they know what's coming?
I think a percentage do, Lucian. It's easy to say. There's various reports that will come out saying, anything up to 70% of landlords are aware of what's coming down the track. That's 30% that don't in a big market of private rental sector. I think what is interesting in terms of the EPC point of view is what we've only seen so far is lenders targeting those that sit and rewarding almost in A to C already. The bigger challenge, to Steph's point, I actually think 60 is more nearer to 70% of properties don't fit level C, but it could be anywhere between there. A big chunk is, to your point, what is the product innovation going to be to help people get from a level D or a level E to a level C? I mean, we already have a product that sort of helps in there. It's almost a refurb to term product. We don't badge it as green, but in theory that can allow people to refurb, do the improvements to get to level C as part of that. I think you will start to see innovation in that sector. You'll hear from Jamie later talking about how bridging can help with that, so I won't steal the thunder too much. I think the really interesting point about this is, it was a survey I read from another lender recently, was around 70% of people think they've already got the funds to do this if 10,000 is the cost. And that's a big if 10,000 is the cost. So do they need additional borrowing to do that? Again, that's 30% that are unaware of the changes, that don't know how they're going to do that. But the big bit is, how do we get the message out that this is coming? A lot of landlords are still holding their breath because they think there's going to be some government incentives.
And do you think the sector has a role in that? Because for me, there's a couple of problems. One is education. Do they know it's coming? Yeah. The second one is, I did something for the Cambridge University Land Society the other day, and one of the questions was, how can you trust somebody with a clipboard paid 100 quid to assess the EPC of your home? So where do you see the lending industry playing a part, Steph, in that?
So I think EPCs will stay. I think that's probably, I think what the government has said so far is actually that's the terminology that the consumers understand. So I think the ratings of EPCs will stay. But you're quite right in that actually we probably need better knowledge, better understanding. how do valuers play a part in that to help consumers understand, and landlords, specifically here, how do they move from E, D into C?
And there's a point here, because there's some real advice, isn't there? How do you do it effectively? What are the measures that you undertake that are cost effective, and where does that advice come from?
I think as well what you're starting to see is that there are tools to see how your property rates online.
Yeah.
We have a duty as lenders to start pushing it out. I also think estate agents, take this in the spirit, have a duty to start promoting this a lot more.
Right.
Strangely enough, I was looking at, just before we did it, some properties online to see how this panned out. And actually what surprised me is that, properties that have been built in the last 2 or 3 years don't necessarily fall in A. And that was a real surprise to me. So it started to show to me that, the availability to look at properties when you are looking at them online is much more prominent in terms of their EPC ratings. But I think, you will start to see lenders push the agenda on this. You'll see the trade bodies from the point of view of IMLA, Amy, start to push this too. Distributors, the sizable distributors such as the business Steph works for, will be prominent in pushing this bit forward, because 25 will come quickly.
Won't it come very, very fast? And with that in mind, I think it's probably time to get you lot involved anymore. And the room's quite cold. So instead of raising your hands, I'm going to ask you to stand up now if you know the EPC rating of the property you live in. There's a gentleman there who thinks he knows, which is great. He doesn't know whether to stand up or not. That's fantastic. Right, so, and because it's cold, you can all sit down. If you didn't stand up, can you all please now do 10 star jumps? No, that's really not very fair. So look, there is a major problem in here, isn't there? And I think we can see there that the industry's got a part to play. And it sort of fits in with this wider area of regulation and incentive for me. So let's kind of stick with regulation and incentives around the first-time buyer and build-to-let side. Help to Buy hasn't got long left, has it? What does that do? What do you think that does for first-time buyer demand? Where does that put the pressures?
So Help to Buy won't be extended, so you're quite right. It goes in March 2023, but actually developers are so forward sold. Actually, probably last properties on Help to Buy will probably go in the middle of the year. I think actually Help to Buy sort of solved provided a solution for the three key things that first-time buyers, struggled with: affordability, deposit, and lack of property stock. And I think once Help to Buy goes, there aren't really any schemes to fill that gap. 94 billion worth of property value has been put through Help to Buy, helping 83% of first-time buyers. That's a massive chunk of the market. That what do we do next? And I think from our perspective, we're looking at all these alternative schemes, looking at how they fill a void. 95% lending plays its part, but actually, if you look at mortgage affordability, between a 95% lending product and Help to Buy is about a £300 a month mortgage payment difference, and that's considerable and will really impact first-time buyers being able to step on the ladder. I do think we'll see sort of a re-emergence of shared ownership. I think we'll see the private equity schemes that we've all probably seen start to come to the fore, partial home ownership. But the time for advice for first-time buyers has never been more key, Lucian, if I'm honest. Yeah, because they are, it's a difficult enough landscape.
And there's a range of products, isn't there? And you can sort of see Help to Buy goes. The house builders are acutely aware of that. They've made some nice profits recently. They're going to be very wary about it going. They're going to put in their own schemes like Deposit Unlock. I think that's kind of quite interesting. Nationwide are on board with that. So if you like, that's one part of it. There's also this government scheme which is going to be first homes. Do you think the specialist lending sector is going to play in that first home space, or do you think that's going to be the one? Because that's quite niche.
It's very small.
It's also not very large. To Steph's point, I think that there's limited numbers on that. I mean, we play in multi-brand strategy through Precise. We lend in Help to Buy, and I have to say, Help to Buy was a massive success as an initiative, as a proposition to get that. It's
taken a kicking, though, hasn't it, politically?
Yeah. I mean, the comfort of Help to Buy, though, I think from a lender's point of view, is the government-backed guarantee. So, what replaces that? Is it private? Do lenders still have the same confidence in that? We do a lot of shared ownership. It's a big part of our market in the affordable housing market. I think we're one of only 2 lenders that will do 100% of share, and we've seen more demand for that over the last 12 months. Does the Bank of Mum and Dad come into this as a solution? Do we see that growing further in the top 10 because people will rely on
which is great, but politically it's a horror, isn't it? You know, your ability to get on the housing ladder is dependent on the financial circumstances of your parents. It just doesn't feel right.
A two-tier housing society. But I think, you know, you do see more specialist lenders playing the higher LTV point. I mean, our criteria is back to what it was pre-pandemic. We will end up to 90% loan to value. I think you see lenders look at that stuff that doesn't flow through the sausage machine of the high street, so the ability to look at people's additional income in a different way. Potentially you can look at joint borrower sole proprietor. I'll stutter that out in a minute. So there are solutions, Lucian, and I don't think the builders aren't going to want to see new builds slow down. So they will be looking at solutions and they will be pushing things to come out.
Yeah, and the HBF has come in quite hard on that. So you've talked a little bit there, and we've sort of got into constraints on loan to incomes, where you play in that higher loan to income space, how you deal with LTVs. Bank of England, really interesting in their financial stability report last time round. And I must admit, I fell off my chair. And it was quite a high chair, so it was quite uncomfortable.
You hurt yourself, did you?
Well, look, I'm approaching 50, and pretty much anything seems to hurt at the moment. So Bank of England, financial stability support, suggesting that they might do away with the affordability stress test at 3% plus SVR. I mean, first one, we'll do another poll. So that was a main plank of mortgage regulation, along with 4.5 times LTI, and along with the five-year test on affordability. Do you think they'll do it? Do you think actually when push comes to shove, they'll do away with that stress test? Or do you think it's just wishful thinking?
I think it would. I'm not sure. I think I'll sit on the fence. I'm not sure. I think it would be positive for first-time buyers. I think we're in a very different market to where we were when that was first introduced. I think lenders have got comprehensive affordability calculators, robust, prudent lending. So I think if it does move that way, I don't think we need to be overly concerned. It probably is constraining, things slightly. So I think possibly, Lucian. I know that's probably not very.
Well, no, but possibly. I live my life saying possibly. For a researcher, it's one of my favourite words. It kind of has to be said.
I think you come into a bit of a perfect storm in some ways, don't you? Because actually, one of the not all regulation is bad, first and foremost. So, we're not in 2006, 2007 fast track lending, self-cert lending. All income is assessed. Whether that be by high street lenders, by specialist lenders. So you have the bit where lenders get comfortable that they can prove the income, the affordability, the sustainability of the income. And actually, MMR was all about that: plausibility, affordability, suitability. So actually, you've got a good regulated environment to assess income. I think the challenge for the Bank of England is when they started this process and said they would consult on it and look at it, is that since then you've seen inflation rise quite a bit. You've seen, the positive employment levels being strong. But you see, as I said, inflation go up, and what you're also starting to see now is a movement in bank base rate going up. So actually interest rates going up.
So your stress test is off a higher base.
And our wages increasing. The one bit I would say in this is that even though at the moment you use 5-year money to stress affordability and you can go without the 3% on variable, 5 years money is still very cheap, very affordable, very popular. I think we've moved away from, a society or a market who like 2-year fixed rates for everything. So you do have the ability on 5-year to be there. Whether they go through it or not, I don't work for the Bank of England, I don't know. But I think there's more questions around it now than
right, great, okay. Audience participation time again. I think we'll go with hands this time, but just for a bit of variation, we'll go with both hands. Do you think in the next 2 years the Bank of England will ease mortgage regulation? Hands up for a yes. There we are. We've got one at the back. That's a pretty damning indictment, isn't it, of the prospect of an easing of mortgage regulation, which in many ways, I guess, is very good news for the specialist lending sector because it continues to maintain demand.
It's very good news for intermediaries because people need their expert advice.
Yep, absolutely. Right. Other things that might happen in the lending market. We've talked a bit about ESG. And there's been a lot of chat about that government consultation on landlord regulation. There's also the government consultation on, are we going to set you targets specifically for lending for energy improvements? And are we going to set some targets for the EPC profile of your existing loan book? How do you think that's going to play out? What are the dangers? Do you think it's going to mean differential costs of borrowing, differential terms of borrowing?
I think some really unintended consequences to this if we're not careful. So I think lenders could very easily start to balance their back book by only taking in properties that are C rated or above. But what does that do actually for the market? As you said, we create a two-tier market. Do we create green mortgage prisoners? So I think we've got to be very, very careful as you balance that as to, as Adrian said, we need product innovation. We need to encourage customers to make these energy improvements. My understanding is from the consultation is actually that the lenders will be encouraged to improve the performance of their back book. So actually, but how do we get customers to do this? Is it carrot or stick? I think the legislation we're seeing for landlords is more stick than carrot. But how do we get the general public to realise that actually they've got to do this? And the savings are quite small compared to the outlay. So
you can sort of see the way the government's saying, if I was being devious and slightly Machiavellian, which I don't mind doing occasionally, then you can see that what they're saying is, look, the returns on the improvements from energy saving costs are so small. So let's create a differential in cost of debt. So you start feeding that into the equation. It really encourages to improve the energy performance of their home. And you read the consultation, it actually says, look, we're going to set, you come up with the targets, but if we don't like them, they're going to be ours. So my view is it's coming. One way or another, it's going to come. Do you think that creates, because we've got some sectors that are difficult there, haven't we? Listed buildings. I live in a listed building, EPC rating, G. This is I literally go around the house every night shoving bits of cotton wool in the gaps between the inside and the outside house to try and reduce the energy leakage. Specifically, Adrian, are you going to provide a mortgage product for me with my energy inefficient listed? Do you think that opens up an opportunity for those that are going to be problem assets?
I think people will look at different assets. Lenders will look at different assets. I think as well. You raise a really interesting point there. You don't want to close the market to people who live in these properties. They haven't had the opportunity there. I think you also from a buy-to-let point of view, you don't want landlords all looking to buy new builds. You still want a sector where people can go and have a choice of different types of property. So I think you will see lenders become innovative, but look at the type of stock that's there and look at the type of solutions. And actually, is it specialist lenders that are the home for sorting that? I don't know, but I think you'll certainly look. Every lender looks at the next emerging market and the way in which they can support them, particularly specialist lenders.
Fantastic. Look, we've spoken a lot. You've all been incredibly patient. The level of audience participation exceeded anything I ever anticipated, apart from the last question, which frankly was a disaster. And some of you need to take a good, hard look at yourselves. But let's open it up to the floor. Have we got any questions? And I would encourage you, we have got 2 minutes, 43 seconds, so don't be shy in coming up with something here. What have we got in the room? There must be something. Show of hand, usual way. You've got an absolutely outstanding panel. I can't start saying. And look, here we go. Gentleman here in it looks like a rather nice green sweater.
Good morning. Good morning. Just a quick one, well, two questions really. One is that you're talking about obviously the rate competitiveness, rates going one way, lenders competing for margin. And with the news on Marshaven this week, do you think that's hopefully a one-off, or do you think there might be some real issues around the market in the sense of funding? And secondly, do you have any idea what you think the size of the specialist market might be?
Who wants to take it?
Yeah, I'll pass on the Marshaven one because I don't know the ins and outs of it, Ian, to be fair. But I think, you have an awful lot of lenders, if I talk generally in the specialist market, vying for a slice of the pie, and there is only so much to go around. But I don't know the ins and outs of what happened at Marshaven. So you possibly will see some M&A over the course of the year, potentially. We saw that last year with Fleet being acquired by Starling Bank. So I think there is strength in numbers and strength in backing. Size of the specialist market, well, if you look at, I'll just take buy-to-let because I think that's an easy chunk to look at. So if you look at it last year, gross lending, 45 billion. How much of that was specialist? You're probably going to look at least half because the amount of stuff that was done in a limited company basis, the amount of PTs that would have been in there for banks like ourselves that rolled over. So I think in buy-to-let, it's a big chunk of the market now. You take out BM Solutions, TMW and Coventry. The rest of it is pretty much made up of the specialists now. Residential is a harder piece to pick because I think a lot of the big boy lenders, to the point Lucian made at the start, really targeted that low LTV vanilla stuff.
Great. Any more questions? If there's not any more questions, then it just comes to me to draw this conclusion. I think they've been an outstanding panel. They've thrown themselves out there. It's not an easy thing to do. So if we could show our appreciation in the usual manner, that would be great. But if you want to holler and cheer, that would be even better. But here we are. Thank you to the panel.